Welcome to this video in which we're going to discuss the short-term funding options or alternatives available to corporations, to corporate borrowers. And there's going to be a follow-up video to this one in which we will discuss similar topics, also short-term funding alternatives, but available to financial institutions. This one is focused on corporates, i.e. non-financial, not banks and other financial institutions. And we're going to talk about short-term funding, basically the ways in which corporate clients, corporate borrowers can borrow money, so engage in debt funding, debt financing, take on debt financing, so financing of an external nature, be it in the form of short-term loans or short-term securities, debt securities which they will issue. So let's focus on sort of loan-based short-term funding first. And here you will need to appreciate the role played by lines of credit. Lines of credit is or credit lines are a very common way of short-term funding taken on by companies. Basically, this is done this is granted by banks. Banks will grant you a line of credit that is a maximum level up to which you can, on a short-term basis, borrow money, which obviously needs to be repaid within a certain maturity, within a certain period of time. But it provides a flexible option to, whenever you need, take use of the advantage that a line, the ability to borrow, has already been pre-agreed, and you don't have to negotiate it every time you need to borrow. Now, these lines of credit, unfortunately for you, come in different varieties. There are three that you'll need to know about, and you'll need to understand the advantages, disadvantages of all the three types, both from the borrower's perspective as well as the bank's perspective. Right, so this is very good, potentially, for a theoretical question, something that you need to learn. Let's start with the first one. This is called the uncommitted line of credit. So uncommitted lines of credit, that's the sort of the name that you need to know, focusing on the fact that it is uncommitted. Right, let's state that this is the least reliable source of funding for a company. Why? Well, the key to understanding this lies in the name, the word uncommitted. Here, a bank will tell you, oh, yeah, you can borrow up to a specific amount, but if your conditions as a borrower change, as a company change, the bank may decline to provide you a loan. So this is all good as long as your condition remains relatively stable and healthy as a borrower. If that changes, the bank can revoke its pledge, because it's not really a pledge, it's uncommitted, so at any point in time it can disappear. Hence, it's not very reliable. I'll present you with some more reliable options in just a moment, but this is something you also need to know about. Your curriculum states that this is more popular or used more frequently in the United States than elsewhere. Okay, so what will the bank do here? Well, the bank offers, so such an uncommitted line of credit is offered up to a specified amount. That's the amount, the company will be able to borrow, and this is a specified principal amount, the amount that is borrowed and then needs to be returned. Obviously, when you return plus interest. That's the credit line. This is often known also as the credit limit. And it's also offered for a specified maturity. Okay, a specified maturity. The next point is that when you take advantage of the ability to borrow under such an uncommitted credit line, you will be charged. So the line will charge whatever is the market reference rate. If you're in the Eurozone, that often is the Euribor, for example, as the Eurozone reference rate, plus some spread above that rate, and that spread is going to be borrower specific. So each company will have a different spread above the MRR depending on its financial situation. However, the charge of the MRR plus spread, that's going to only apply on the principal outstanding, so the amount which you actually borrowed. You will not be charged interest on the whole credit line, only on the portion of it which you actually used, so the amount borrowed, so on the principal outstanding, and it will also be a function of the time when the funding was used. When funding was used or the principal was outstanding. So the shorter you pay this money back, the less interest you will effectively be charged. Now, if business conditions or market conditions, business conditions are relatively stable, this is brilliant. Uncommitted lines of credit are the most flexible option available, and it's also the cheapest option available. However, of all the external funding, most flexible, cheapest source of external, that is debt funding. Source of external meaning debt funding. Your book calls all of this, external funding, to differentiate from funding coming within from the company's own capital, or from the capital given to it by investors. So that's external funding, which will need to be repaid, hence debt. However, that's only if business conditions are stable, because, as I said before, if the situation of the borrower deteriorates, the bank is absolutely it's possible for the bank to revoke that credit line, take it back, cancel it, and you will not get funding. So it cannot really be relied upon fully. Now, another feature of this, which you should know about, is that it is typically offered on an unsecured basis. Unsecured, meaning without the need for any collateral to be provided. But that's only if the borrower, that's the client, maintains a stable cash balance with the bank. So you need to have your accounts at this bank, which is giving you the line, and the bank will want to see what's happening on your account, what the inflows and outflows are, to possibly monitor your health, your situation. If they see that the cash situation of the company is deteriorating, then they may actually decide to decline to lend you under the uncommitted line, because they have the right to do so. It is, after all, uncommitted. And you may think to yourself, hang on, if a company has a stable cash balance, why would they want to borrow money anyways? Well, the thing is, as a company, you don't necessarily want your cash balance to get depleted down to the very sort of last cent, or what the last dollar or pound or whatever. So sometimes you, as a matter of policy, want to have a balance, a positive balance on your account, and keep that balance positive, even if it means borrowing money, especially for something unexpected and so on. Maybe to be, maybe you'll want to make sure you can use or pay for something when the opportunity arises to acquire maybe additional inventory. So you want to have a positive balance. And what the bank will want to monitor is whether, even if if you've got drops in your cash balance, whether those drops are maybe quickly replenished. And if they see that generally speaking, on the long-term basis, the company does maintain a good, solid cash balance. Obviously not every day, not the same fixed amount, but if they see signs of good cash management, they'll keep that credit line open, absolutely. Now, however, if they see something worrying, the bank may decline to lend under the credit line if conditions deteriorate, if they spot something worrying happening to the borrower. And therefore, your book says that such uncommitted lines of credit, from a borrower's perspective, should really not be relied upon. They cannot be relied upon as the primary, sort of the main source of external funding of a company. The commitment is just too weak source of company funding. Now, there is a flip side to this as well, because you also have to appreciate the situation from a bank's point of view. You see, whenever banks either lend money or commit to lend money, they typically need to create or keep what's known as a capital reserve, a capital buffer. That is, a part of their equity needs to be reserved or in some way buffered or act as a buffer to absorb potential losses which may stem from that loan or that commitment. Because over here they may at any point in time withdraw and decline to lend, uncommitted lines of credit are quite good from a bank's point of view because they do not require the bank to hold large capital reserves, and whatever capital or equity the bank has may be used as a reserve for something else. If you start making committed credit lines, lines of credit, which we'll talk about next, you have to really block a portion of your capital or block a portion of your equity for that purpose, and in that way it cannot be used for something else which may generate profits as well. So this is good because it frees up, or it doesn't block the capital of the bank. Another couple of points here that you just need to know about, a couple of features. We said that the borrower here is charged interest, and that interest is charged on the balance, on the principal outstanding, which is also a function of time for how long the funding was used. But they pay no other compensation, but pays no other fees or compensation to the bank, which is good. And it's also a reflection of the fact that this is a very weak form of commitment. It's an uncommitted line, so the bank may revoke it, hence you don't have to pay anything other than for the interest on what you actually used. Another point which your book makes is that from the perspective of the bank, for a bank, this may be viewed as an instrument or as a way that helps you to maintain and build and kind of manage long-term relationships with your corporate clients, business clients. And another point, I think, I'll mention it because your book does talk about it, is that banks, every loan that you make in a bank has to be funded by something on the liability side of the bank, or the equity and liability side of the bank's balance sheet. So banks often fund these loans made under uncommitted lines of credits with stable deposits. That is, deposits from clients which tend not to fluctuate so much in value. When you've got a deposit base in the bank, that is money deposited at the bank by your clients. That will change from day to day as clients withdraw money, but there's typically a core base of deposits which tends not to fluctuate, And that's what we mean by stable deposits. Okay, enough on uncommitted lines of credit. What's important is that you differentiate these and you understand the difference between these and the next one, which is committed or regular lines of credit. So a very similar setup, but this time it's going to definitely be more reliable because of a fixed commitment from the bank. So this is more reliable as a source of funding than the previous one. This involves a formal written commitment. That's what your book says. Hence, its reliability factor goes up. Right. Obviously, from the point of view of a company, this is much better. A bank will not be able to decline to lend under this kind of agreement. So what the bank will basically tell you, hey, you can borrow up to a specific amount for a specific time period, like 1 year, or just below 1 year, or whatever. And during that time, they have to lend to you up to that specific amount, even if your condition is changing, right? So that's a lot more risky. For the bank, or from the bank's perspective, this will require the keeping of much larger capital reserves, requires definitely more or higher so-called capital reserves within equity. You'll have to create a buffer for the potential losses that this may cause. But your book is quick to stress here, this requirement may be lowered, but this may be eased or lowered by making commitments for less than 1 year. Because in many jurisdictions, banks are required to keep lower reserves in the case that loans or commitments are made for less than 1 year, by making commitments for less than 1 year. So, for example, 364 days, evidently being 1 day shorter than a year, that's okay. Now, if you've got a large corporate wanting to make use of a committed credit line, so in the case of larger borrowers, where a bank would essentially need to create a big capital buffer, the reduction is achieved in a different way. Reduction of the capital requirement. So let me stress again, this is a portion of your equity which you kind of have to hold aside and not use for anything else, because it has to act as a potential buffer to absorb losses. So the reduction in the capital requirement may be, or will typically be, achieved by grouping together, ganging up with other banks and creating a syndicate and saying, okay, we'll give you this committed credit line, but we will share in the granting of the loan and creating the buffer for potential losses. So here, the case is going to be that the banks forming the syndicate share. There's a sharing of the commitment and any loans that are made under the commitment, and also the responsibility for potential losses that may arise should the borrower get into significant trouble. Okay, right. Even though this is a reliable source of funding, it's only going to be reliable for a specific amount of time, because if you've been given or granted a committed line of credit for a period of 1 year or perhaps 364 days, what about when that period is over? So you've borrowed money, but you'll have to potentially repay it at a specific date when that line of credit finishes, its maturity date comes. So even though it's reliable, let's say, but, with an exclamation mark, there is the risk of renewing the credit line at maturity. Because, if you are heavily indebted, if you have heavily drawn under the credit line, so you've got a lot of debt to repay, and the date of the commitment is drawing to an end, or coming soon. If your condition as a borrower has suffered deteriorated, the bank may not want to renew that credit line. In which case, this becomes risky, because you'll have to repay once the date comes, unless the bank grants you a renewal and says, okay, here we go, another 1 year or 364 days. When you can still not pay me, we'll just compute the interest. Now, this type of line is going to definitely involve more costs. Not only do you have to pay the interest on what you've actually borrowed and for how long, there's also going to be a commitment fee to which you have to agree. And that commitment fee may either be calculated based on the full amount of the credit line, so the limit up to which the bank says I'm going to lend to you, or instead of the full amount, only on the unused portion of the credit line. You see, this may strike you as a little bit odd. Why are you being charged something because on the unused portion? Well, if a bank has given you a credit line for 100, million US dollars, then they needed to create a capital reserve for that full amount. From that full amount, they need to keep a so-called capital reserve, which means they can't use that capital for anything else. However, it doesn't mean the capital reserve will be for 100 million. What you do is you calculate a portion of that 100 million to act as a potential loss-absorbing buffer within your equity, so it's not the full 100 million. However, you are blocking some capital which cannot be used for other purposes. And from the bank's perspective, it would be really, really unfavorable if you only used, 20 million from that actually used, because the bank will charge you interest on that amount, but perhaps it was hoping to earn more interest, especially given the fact that they blocked a certain portion of their capital for it. So, the more of the credit line you actually utilize, the more interest the bank will charge and earn money that way. And in order to kind of incentivize you to use the facility fully once you've been given it, they will charge you potentially a fee, a commitment fee, based either on the full amount or on the unused portion over the whole period for which it stays committed, sort of to compensate for the fact that they are not earning interest here. They'll charge you a fee. Hopefully that makes sense. And let's also say that such uncommitted lines, just like their predecessors, the committed lines, just like the uncommitted ones, they are typically going to be unsecured. And also, you can pay them early, prepayable, without any penalty. So you don't have to wait until the final day to repay everything. If you've got the money earlier, you can prepay this without any penalty being suffered. So this is still flexible, and at least it's reliable for a certain amount of time. But once the renewal date comes, you have to think about whether the bank will want to renew, and they may not necessarily want to if your conditions have changed, if the condition has deteriorated, the condition of the borrower. Now, the third type of credit line line of credit is an operating line of credit. So nothing to do with committed, uncommitted, operating line of credit, which is also known as revolving credit or a revolver. It's the name we typically find in banking for this. Operating line of credit or revolving credit, or simply just a revolver. And the book says this is the most reliable source of short-term bank funding, source of short-term debt funding from a bank. So what are the features of this type of facility? You see, it involves a multi-year commitment from the bank. Something that cannot be revoked or not renewed after a year, right? So it's a multi-year commitment. You have to pay it off on a regular basis. You can't pay it off, after 3 or 4 years. Then it would be long-term funding. But at least you can rely on this as a short-term source of funding over multiple years. So you can treat it as a normal source of reliable funding. Now, the lender in this case, it has to have some form of protection. So they'll be protected via covenants. So these are clauses in the agreement which say, if the borrower breaches certain conditions involving their financial ratios, etc., there may be room for renegotiating the agreement or even withdrawing it completely. And over here, the way in which the bank will make money is that the bank charges both an interest rate on the amount borrowed, plus there will be, of course, commitment fees. So they will also charge you a fee for arranging the facility and keeping that commitment to you, just like in the previous version. So this is going to be the most expensive, but also most reliable version from the point of view of a company. We've got the in-between version, that's the committed line of credit, and the cheapest but least reliable one called the uncommitted line of credit. So hopefully that makes more or less sense. You have to know about these in preparation for a potential theoretical question. Now let's talk about 2 more forms. This one is not going to be a line of credit, but it's still going to be something of a loan nature. Secured loans. Right. The previous types were typically unsecured, but a company may also take a secured loan from a bank. So this is different to lines of credit. Lines of credit was a specific form of borrowing in the short term, and now secured loans is going to be a different ones. So if a loan is secured, it obviously requires collateral, so it's going to be asset-based. It's going to be collateralized on something. And what do we typically provide as collateral? Lender requires collateral to be provided by the borrower. In the case of short-term loans, that collateral may be, any asset, generally speaking, of a tangible nature, let's say. So you wouldn't necessarily collateralize on intangible assets such as licenses or concessions or perhaps goodwill or brands, etc. A tangible fixed asset like a building, machinery, vehicles, I don't know. It could be something of a more current nature like receivables, which result from invoices that have been issued where you are waiting for payment by clients. But it has to be good quality, high quality. It has to be receivables against good quality clients. you can have inventory being used as the collateral. You can have, maybe you've got some tradable, marketable securities. Maybe you hold some bonds, or maybe you hold some shares that are listed on a stock exchange. You can use those as collateral. So without having to sell them, you can get a loan backed, or not backed, but based on them. Let me just say that if you use receivables as collateral for a bank loan, you, the company, are still responsible for collecting the money from those receivables, so chasing clients to pay you, etc., etc. Now, the thing is, when that collateral is established on a specific asset, that pledge, or the so-called lie-in, which is a very sort of specific word in English, is going to be added to the company's financial records. So when you read, for example, the financial statements of a company that has used certain assets as a basis for getting a collateralized or secured loan, the investor will be able to get that information from the financial data, companies' financial reports, their financial records. So you'll see what's been pledged against what. And who uses secured loans? Well, this is used primarily by those companies who do not qualify because of their typically because of the unstable nature of their operating cash flows, qualify for unsecured loans, short-term loans like the lines of credit we described before. Those are typically unsecured. If a bank doesn't want to give you that kind of lending, we think about alternatives, how to structure the loan, how to secure it on something that's going to be protect the bank's interest. Now, another form, once again, of short-term funding of a loan nature, so loan-based short-term funding. We've seen lines of credit, 3 different types, secured loans, and now the third and final one is something called factoring. This is a very specific type of transaction, or a very, very specific setup, so to speak. This is where, if I'm a company that sells to external, well, we sell to some buyers, and we sell on trade credit, meaning my buyers receive an invoice and they have, let's say, 3 months to settle for their purchases. You will have an account receivable in your balance sheet because you're waiting to receive money as a result of sales already performed. Somebody has taken the goods and they have, let's say, 3 months to pay you. You can sell those receivables. So selling of trade receivables, they're typically trade receivables, or as we call them, accounts receivable, to a financial institution. And that financial institution is formally known as the factor in this case. They buy the invoices from you, or they buy the receivables from you. They pay you money upfront for it, but so the seller of those receivables or those invoices receives money from the factor, but it's a discounted amount, meaning you don't receive the full amount. If you made a sale, let's say this is a company and this is a buyer, and you sell them some goods, and the buyer gets an invoice, and the buyer has to pay, let's say, 1 million in 3 months' time. But in the meantime, the company is strapped for cash, right? It's waiting to receive that cash, and it has to pay wages, it has to buy inventory, raw materials, cover various forms expenses. So what they may do is they now have a receivable from that client. That's the client, the buyer, and that receivable may be sold to a factor. And the factor will pay you not the full 1 million, but less than 1 million. And then it will be the factor who will basically collect the money, the 1 million from the buyer, and that's going to be their profit because they gave you, the company, less than 1 million, and then they're waiting the 3 months to receive the full 1 million. And in reality, there are different ways to do this factoring. It's much more complicated than what your book describes. There is without recourse, with recourse factoring. So the world is much more complicated than the curriculum describes. Your curriculum says, and just take it as it is, what the book says is holy, and what you need for the exam is that the actual business of collecting the money or the receivables, so basically chasing that buyer for the payment, now is transferred or shifted to the factor. So once the company has received money from the factor, less than the million, it's a discounted amount, it's now the factor's business to go after the buyer and chase them for payment. Not really necessarily the case always. This is only true factoring without recourse, but it doesn't matter how it is in reality, that the fact that it's complicated. And let me just say that how big this discount is, so how much less you receive from the factor, this is going to be, this is the cost of using such an arrangement. So the cost of the factoring, the cost of using this form of funding depends on, obviously, on the riskiness of this arrangement to the factor. So that will depend on how probable it is that they will receive money from the buyer without any problems, or indeed how likely it is that the buyer will have problems to pay. So depends on the quality of those receivables. And obviously the collection costs which we anticipate. How much money will we need to spend to actually get the money out of the buyer? If it's going to be just a formality, then the factoring should be much cheaper than if we anticipate trouble. Right, these were different forms of loan-based short-term funding, typically provided by banks or bank-like institutions. Factoring is typically provided by banks or bank-affiliated separate financial institutions. Now we're going to talk a little bit about security-based short-term funding. So alternatively to getting some kind of loan that will need to be repaid, we're going to think about issuing some form of short-term debt in the markets to investors as opposed to borrowing money from a bank. That's what we mean by security-based. So especially large corporates, not medium-sized, not small, but large corporates, sometimes issue, not always, what we call commercial paper. Commercial paper is basically like short-term bonds, or the equivalent of short-term government bills. When governments issue short-term debt, we call that bills. In the world of corporates, we call that commercial paper. Okay? And this may be issued either in the public markets, where pretty much anybody can buy it, or it can be done via what we call private placement. So it may be issued and addressed, the issue may be addressed to a selected group of investors without going through the whole process of doing this publicly, which is always more bureaucratic, more cumbersome, involves much more time needed and costs as well. Now, when companies borrow by issuing short-term debt securities, the typical maturities, so this typically matures in under 3 months. So it really is quite short-term. And the way companies use this, or the reason why they do it, is this funding gets used to basically, this money gets used, the borrowed money gets used to fund investments made into working capital. So things like buying inventory, for example. And the fact that once you make a sale, the client doesn't pay you immediately, especially in business-to-business transactions. So funding receivables, you have to wait for the money to be received, and in the meantime, require funding. Or maybe short-term fluctuations that you've got in your cash, fluctuations in your cash. As I told you, companies typically want to have a bit of a cash buffer. So if they see their cash fluctuating quite a lot, they'll borrow money so as to have a bit of a cushion to sit on and to provide some kind of comfort against unexpected outlays. It can also be used to fund working capital, fluctuations in cash, or used as what we'll describe as bridge financing. And bridge financing, as the name suggests, is a bit of a sort of intermediate form of funding. So this is interim funding, temporary funding, until something more permanent can be found. So until more permanent funding can be arranged, like a big bond issue for a longer term. Sorry, got that completely wrong. Let me write this again. Until more permanent, that's good, funding can be arranged. Yeah, like a bond issue, or maybe a big syndicated bank loan, long-term loan from banks. Those typically require more time to get ready than a short-term issue. How does this security-based short-term funding or commercial paper funding get repaid? Well, it typically gets repaid using or with money coming in with proceeds from a further issue. So from a new issue, you repay the old maturing debt after, let's say, 3 months or less, with a new issue, so borrowing more. We call this a rollover. So you'd say that the debt or the funding simply gets rolled over, and this of course presents a risk. It's called rollover risk. What if the issuer is unable to get fresh funding? Nobody wants to lend to them, right? So rollover risk, the possibility that the issuer is unable or will be unable to issue new commercial paper, or simply new paper. We know it's commercial paper. So because of this rollover risk, the buyers of these securities may feel, well, this is too much risk to take. And as a result, investors typically require the company issuing such commercial paper to have a pre-agreed with a bank, something strange, to have a committed line of credit. And there we go back to the previous topic. They want to see an agreement made with a bank for a committed line of credit for a specific amount of time. So that will act as a backup. If you cannot issue fresh commercial paper, you'll go to the bank, which has committed the line of credit to you, and then you can, as a company, draw from that or under that line of credit, repay your commercial paper, and then owe money to the bank. So that's a way of pushing the risk over to a bank. And banks actually, grant such committed lines of credit, and they charge a fee for them. So even if they don't get ever used, it's like a bank guarantee. Even if you don't use it, you still have to pay an upfront commitment fee for it. Good business for banks and protection for the investors. So this is to ensure that the issuer will be able to repay the money at maturity, even if the money comes from not another issue, but from a line of credit granted by a bank. So this is used as a kind of backup, used as a backup solution, this kind of arrangement may be known as a backup line of credit, to differentiate it from lines of credit granted for other purposes. Backup line of credit, and also another name you may want to commit to memory, if you can, stuff your memory with something, with some more terms. This could be referred to as a liquidity enhancement measure, or simply a liquidity enhancement. If you can, remember it. If not, well, you don't have to remember everything. So let me also say that because these security-based short-term funding solutions, i.e. the issuance of commercial paper, it typically gets issued with very or relatively short-term maturities. Defaults over here are going to be quite rare. Defaults are rare because it's short-term debt, and you can typically quite easily forecast, or with increased predictability or probability, forecast what's going to happen in the short term to a company's condition. Plus, we have these backup lines of credit or liquidity enhancements which act as support here. So defaults are relatively rare. Let's just say one more thing. If these things are issued in not just the domestic market, but in international markets, you may encounter the phrase or the name euro commercial paper. Now, it doesn't have to be issued in the euro currency. The appendix euro in front of something means it's typically issued outside of the home market. The abbreviation for this would be ECP, Euro Commercial Paper, whereas just standard domestic commercial paper would be the letters C and P. Okay, let me check my notes over here. My notes on this topic, that is short-term funding options or alternatives available to corporates, to companies, i.e. not financial institutions, is over. The next video is going to be on similar options available to financial institutions, primarily banks.